Okay, hello everybody, and welcome back to another episode of Milkshakes, Markets, and Madness. And I'm going to highlight that last word because things are getting more and more maddening, and you can see it in the news, you can see it in the markets, and you can certainly see it in people that you talk to, and especially you can see it with people you interact with on social media. And so we're going to talk a little bit about that madness today. And we're going to talk about a number of Twitter interactions that I had this week, which are both related to the madness and to the milkshake and to the markets. So it's actually fairly apropos that we're going to highlight these. And I'm going to try to use these interactions as a way to hopefully help educate some people who are perhaps not as knowledgeable as others, or perhaps are knowledgeable but just need some clarification on things. And finally, just need clarification on my views or what it is that I actually think you should do or should not do. But before we get to that, let's just take a look at some of the highlights of the week here. Again, we've kind of we had the Fed meeting. Was it last week or 2 weeks ago? I think it was last week. And they cut rates and indicated that they likely to do so again before the end of the year, depending on the data. And so PCE was a big one that came in this week. It came in a little bit dovish. GDP basically came in flat. But the market didn't hate these, and they certainly weren't hawkish, and so it certainly didn't dissuade anybody from thinking that, wow, the Fed is no longer going to cut. And gold had another good week. It closed up, I think, another $25, $30. Closed at an all-time high, 26.58. It pulled back a little bit from it. It was around 26.80, 85 maybe at one point. We're going to talk a lot more about that a little bit here. Silver had another good week. It was basically flat, I think, up slightly, closed above 31 again. Oil pulled back again. It's back down below 70, in the high 60s now. And the VIX index was relatively flat most of the week, but it rallied Friday afternoon. And so, we're going to see what that brings next week. Again, equities had a pretty good week. The Dow, I think, ended at an all-time high. The S&P and the NASDAQ didn't fare quite as well. And everything pulled back Friday afternoon as the VIX started to rise. Now, what the exact catalyst was for that, I'm not sure. And whether that will continue into next week, I don't know for sure. My bias is that the VIX is going to climb, and that we're not going to have such a sanguine markets as we've had for the last couple of weeks. But, let's wait and see. And then finally, the really big news of the week, probably the biggest news of the week, was China finally could no longer withstand the deflationary pressures within their economy. And they basically opened the floodgates on stimulus, injecting money into the system. So anyway, a pretty interesting week overall. But for me, the big thing that was going on in my world this week was, we've spoken the last couple weeks, really the last month. We've talked more about gold over the last month than we typically had. That's, it makes sense. Gold is at an all-time high. And we've used that to kind of explain my thoughts on it. And last week I said that we were going there. I think last week's title was, there's going to be blood, right? Gold, there will be blood, because of positioning, because of sentiment, because of relative strength. And so basically, when gold hit its all-time high on, it was either Wednesday or Thursday, I can't remember which one it was. I think it was Thursday morning. And I have a process: when things get really oversold or when things get really overbought, I am happy to do some short-term tactical trades. And so as part of these short-term tactical trades, we bought some puts on gold on Thursday morning. Gold was around 26.80 at the right time, so 26.78, 26.80, something like that. And listen, we bought golds on puts on. We had actually bought some the day before on GLD and SLV, and then we bought more on Thursday morning on GLD, SLV, and GDX, and we bought them anywhere from 1 to I think 1 to 3 or 4%, maybe 5% out of the money, depending on which instrument. And the expirations are anytime between late October and the end of the year. So we'll see how those goes. Again, the short-term tactical trade, I was very clear that I was not selling our long-term strategic gold position. We think everybody should own gold. Hopefully you bought it years ago and you're not having to buy it right now at all-time highs. But listen, just to be absolutely clear, if you don't own any gold right now, you should absolutely go buy some. I mean, I've said for as long as I can remember, everybody should own gold in their portfolio. I don't particularly like buying things at their all-time highs. And, as this shows, I'm happy to hedge the gold exposure that we already have and try to make some profits on a short-term tactical trade. But I am certainly not encouraging anybody to go out and sell their strategic gold position. And if you don't own any gold, you should go buy some. And you should just not worry about the price. It doesn't matter whether it goes to 3,000 or 2,000 in the short term. That's not why you're necessarily buying gold right now. But anyway, I sent this, I did it, and I sent this tweet out. And of course, a lot of people didn't like it. But just to be clear, the reason that I did it is all of the indicators that we've talked about on this show before were hitting that this is the time. The RSI is as high as it's been any time in the last 5 years. The DSI, which is a sentiment measure, it had closed in the high 80s a couple days before, and my guess was that it was in the high 80s, maybe even in the 90s real time that morning. It just doesn't get much higher than that. It can, and it doesn't. Listen, none of these things indicate that it is going to crash. All it indicates is that it's more likely than not that we are going to get a pullback or a pause. And I am happy to try and profit from that pause or that pullback. Will it work? We will have to wait and see. But again, this is not a gold crash prediction. I'm just explaining the process through why I decided to take a short-term tactical trade. And then not only that, but we have the biggest position on the COT, the commitment of traders. The speculators have their biggest ever speculative position, and the commercials have their biggest ever, or almost their biggest ever, short position. So now again, any of these on their own, it's probably not a tradable signal. But when they are all lined up together, that tells me the risk reward is pretty favorable and it's worth taking a shot at. All investments involve risk. You cannot make an investment and remove all risk from the table. And when everything is printing like this tells me that the risk reward is pretty favorable. And not only that, but to be clear, I didn't short gold. I'm not shorting gold. I bought puts. When you buy puts, you're spending money to buy premium on options. The most money you can possibly lose is the premium that you spent. So I have a very defined level of risk. It is impossible for me to get quote unquote wrecked on the trade. Can I lose money on the trade? I can absolutely lose money on the trade. But the trade is not as such a size. This is not my whole portfolio. The whole portfolio is not going into puts on gold. We still own gold. We still own equities. We own some short-term fixed income. There's a lot of stuff that we own in the portfolio. Remember, you should have a diversified portfolio. You should not have all of your money in one thing. So when I am doing a short-term tactical trade, it's with a small percent of the portfolio, and it's done in a way that the risk reward is in my favor, and I cannot possibly get wrecked even though I can lose money. So anyway, so let's move forward. And if you look at this chart, the chart I highlighted, it showed the prices at its all-time high. It showed the relative strength, again, back in the 80s, which is high. And it shows the stochastics, which are at 99. Now, the stochastics are basically a momentum indicator, just really simplified. It's at 99. So can it go higher? Not really. Does that mean gold is going to crash? No. But again, when you're clear up at the top, there's typically only one way to go, and that's down. And so that's all of these things combined is why I decided to take the shot at it. So now with all that said, I always have to laugh because so many people tell me that they own gold for the long term. They don't really care whether it goes up or down in the short term. But it sure is funny. People who say they don't care if their favorite investment goes down in the short term sure do get upset when you tell them it may go down in the short term. And they get even more upset if you say you placed a trade that may profit from it going down in the short term. So I had a lot of interactions with this over this week, both on the phone, in email form, in DM on Twitter, and on Twitter itself. So this turned out to be a rather big part of my week, and this is probably one of the biggest drivers of this of the contradiction or the the argument, however you want to define this, and this is the commitment of traders. Now, the commitment of traders tracks gold positioning. And so typically what this is showing the commercial swap position. I'm going to go through and I'm going to explain what the commercials are, what the speculators are, et cetera, et cetera. But what this is showing is it's basically showing that and actually I have this mislabeled here. This is not just the swaps. This is the commercials, the commercial short position. This is the entire commercial short position. It's around 340,000 contracts. Now, you can look at this chart and you can see the typical inverse correlation between the gold price, which is in black, and the commitment of traders' commercial short position, which is in pink. Now, in general, this doesn't mean that much, but at the extremes, I think it's extremely helpful. Okay. And so I'm going to go through and I'm going to talk a little bit more about these. Now, this I had sent out. Let me go back. I'm going to go back because I think this is important to understand. This chart, some people have a problem with this chart because they will say, of course, the commercials are getting more short as price rises because the commercials take the opposite side of the speculators. So as interest in gold goes up and as the price of gold goes up, it's only natural for the commercial short position to increase. Listen, that is 100% correct. That is not, and that's why I say in general and all by itself, it doesn't necessarily mean a negative. And in fact, it could be argued that this is extremely bullish for gold because all of those people that are short, whether it's the commercials or short or spec, whoever is short, that is a short that could get squeezed and they could be forced buyers. And this is the point I was trying to make on this tweet, which I think we highlighted this in last week's episode. My point was with this, now this is just is this just the swaps or is this the anyway, no, this is the commercial short position. This is not just the swaps, or we're going to get to that in a second. But the reason I highlighted it is I said, there is going to be, when this chart gets resolved, there's going to be tears. Now, I don't know for sure whether the banks are going to be the ones that are crying the tears, or it's going to be the speculators that are going to be the ones buying the tears. Because if the banks have to cover at these prices, we are going to see a short squeeze and you're going to see gold go to 3,000 or 3,500. That is absolutely a possibility. In my opinion, it's an extremely low probability, but it is not impossible. And every time previously that the commercial shorts have gotten to this level, it has ended badly for the speculators who are long. Now, can it be different this time? It can absolutely be different this time. I don't think it will be. But if it is different this time, I will make a lot more money on the strategic long-term gold position that we have than I will lose on the puts that we just bought that have a defined amount of money that can be lost. But so now that just so that we're clear on that, I am not arguing that this is absolutely 100% bearish. I'm just saying historically, when it gets to these levels, that is an indicator that price is going to pull back. So now let's talk about what these things are to begin with. What are we measuring? So again, the commitment of traders, it basically breaks down the different types of investors. And the two big ones, and there's a lot of people that do that. You can subscribe to different services that break down the COT reports by different ways, and they look at it on different things, and they all have their own opinions on how it works. But the two areas that I focus on are the non-commercials and the commercials. Now, the non-commercials, these are the speculators. These are those, or the money managers. These are the people that are long. Okay, these are people that are buying it and typically long, and it could be hedge funds, it could be just pure speculators, it could be individual investors that are trading futures. The commercials, these are the big banks. These are the bullion dealers. These are the bullion banks. These are the brokers that are taking the other side of their clients' trades. So naturally, it makes sense when the speculators are long, the commercials are going to be short. Again, that goes back to explaining that previous chart. It's not unusual as price rises and speculators want to speculate on price rising that the commercials, which are taking the other side of the trade, are going to be short. My point is that typically when it gets to extremes and all the speculators are bidding it up, typically that's when euphoria hits, that's when things typically will reverse. And again, when these charts are kind of in neutral to even medium zone, no big, but when they're at their extremes, I think they're important to use. Now, there's a subset of these non-commercials, there's a subset of there's subsets of both of these, but on the commercials, the other argument that will be made of why this isn't a bearish chart, of why this positioning here is not bearish, is because they will say this doesn't mean anything. This big pink line, it's just the producers, the mines, the people that are producing the gold miners, the corporates, they're hedging their production. So as they're pulling the gold out of the ground, they want to lock in prices. And so how do they do that? Well, they sell the gold short through the futures contract, and then they eventually have to deliver the gold later when they get it out of the ground or wherever it's at. So, and that is true. A section of the commercials is the producers who are hedging their production. But right now, if you look at the total short position here is about 340,000 contracts. The producers, did I put it in here? No, I didn't put it in here. But the producers, their short position is like 70 or 80,000 contracts, which means 250,000 are the speculators. So only about 20% of this overall commercial short position is producers hedging their future production. So the idea that the only reason this is big is because the producers are hedging their production is completely wrong. It's big because the speculators have piled in. And again, a lot of the stuff in general, it perhaps doesn't matter. But when things get to their extremes, that's when they start mattering to me. So and this down here at the very bottom, you see total reportables and non-reportables. It includes all of it. It's basically, it's total open interest. Okay. So that it's basically showing all the contract. What's the total open interest? And it's about 565,000 contracts. So here, if I look at the speculative long position as a percent of the total outstanding interest in the open interest in this futures contract, the speculators long position has never been bigger than it is now. Okay. So again, if this was the chart all on its own, perhaps or just looking at the speculators being long, that's not necessarily bearish. All I'm saying is when they have their biggest long position relative to the total open interest, that gets my attention. Now, the flip side is the swap dealers. Now, again, the swap dealers, that's the portion of the commercials that are not the producers. The swap dealers, those are the bullion banks, those are the financial institutions who are taking the other side of the speculators. Again, in general, doesn't necessarily mean anything. They're just taking the other side of their clients' trades. But right now, they have their biggest short position as a percent of open interest in, well, forever. So to me, that's worth highlighting and it's worth considering. Now, if these were in these positions, but the sentiment was low and the price was kind of just going sideways, and the relative strength was, in the 50s or 60s, and the stochastics were in the 50s or 60s again. So maybe I wouldn't think too much of this. But when these positions are at their extremes, when the stochastics are at 99, when the DSI is in the 90s and the RSI is in the 80s, it means something to me. And so this is why I put the trade on. But the reason I'm going through and explaining this is I want people to understand the thinking. And when you read something on Twitter and they say the commercials don't matter, you got to ask yourself, why are they saying the commercials don't matter? And do they really know what they're talking about? And if they say the speculators don't matter, or if they're saying DSI doesn't matter, or relative strength doesn't matter, all on their own, they probably don't matter. But when you're trying to build a case and everything starts to line up, the odds start to go into your favor. Now, part of the reason that I think I get so much pushback on whenever I do short-term trades or when I talk about gold is because everybody knows I'm also a dollar bull. And they think that I'm just out here pushing the dollar and that the dollar cannot possibly go down. And my point for all the time has been, I absolutely love gold, but it's not going to go to the moon because the dollar is going to die, like is the standard operating procedure for most people in the gold world. Now, could that happen? Sure, it can happen. I can't completely 100% rule it out. But all of the work I've done tells me that's not the case. Now, I put a chart of the dollar up here. And part of the reason that the speculators, or by the way, are so long gold and why gold is at its all-time high is because not just the US, but the whole world, they're back to easy monetary policy. And the Fed, after raising rates a couple years ago, they've been moving more towards easy monetary policy. They just cut rates. The expectation for them to cut more is on the table. And so that's why the dollar has been coming down. Not only that, but other countries around the world are starting to cut rates. China just did a big stimulus plan that pushed gold higher this week. We'll talk a little bit more about that. But the thing I want to make clear about the dollar, if it isn't clear already, is that part of the reason I became bullish on the dollar was because the evidence was right there in front of me, even though I didn't like it. And so what I'm showing here, this is a chart of the DXY going back a little bit over 10 years. The reason I took that time frame is because in 2014, almost exactly 10 years ago, maybe a little bit more than 10 years ago, I think it was the summer, my friend Raul put out a report saying, and he likes gold, and he said he thought the dollar was going to get stronger. And I remember thinking, God, what the heck is he talking about? Dollar's trash. And then over the next 6 months, the dollar went up about 15%. And that's that first blue circle on the left side of the chart there. And that's about the time I was like, well, he's a pretty smart guy. He saw this ahead of time. He thought the dollar was going to get stronger, and lo and behold, it did. So what did I miss? Oh, and by the way, this coincided somewhat with gold going from, I think, 1,800 to like 1,200 or something along those lines. So he had seen something that I had missed, and I wanted to understand what he was seeing. So that kind of started me on my journey of what had I missed. And that's when I realized that everybody who focuses on the dollar falling typically does that when they focus just on the United States. But when you start looking at the world as a whole, you realize the whole world is in trouble. And you realize that the US, despite all its problems, has many advantages. And all currencies trade relative to each other. So that's when I started kind of thinking more about it. And the second blue circle here, the one that's at the very beginning of 2018, that I highlighted that because from January to June of 2018 is when I really started first talking about this whole milkshake thesis. I think it was either January or February when first time I ever said the word milkshake in relation to the US dollar. And it was in I think like a 10 or 15 minute presentation I sent out to clients in early 2018. But it was just one slide, and I said that it's going to be like a milkshake. And then it was later in that year, I think it was May or June, where I did the first ever presentation / interview. I did it on Real Vision. And when I talked about the milkshake theory in detail. And whatever you think about the dollar, whatever you think, whether you think I'm right or whether I'm wrong, I will just point out that I always said the dollar was going to rise versus other currencies. I never said the dollar was going to go up and everything else was going to crash. And since that time, the DXY has never been lower than when I first said that. Now, can it go lower than that? Sure, it can. But I'm just saying, so far, it hasn't happened. And so while I certainly haven't gotten everything correct, and I certainly won't get everything always correct, so far, this has not been wrong. Now, I also want to make the point is, can the dollar go lower? Because we're kind of sitting at this technical level. We're right at this $100 level, which is both, it's been a level of support and resistance over the last 10 years. And we're right at it again. And can the dollar break through here and go down? The short answer is yes, it absolutely can. I've never said the dollar cannot fall over a short period of time. What I have always said is we are not going to have wholesale system-wide de-dollarization where the rest of the world stops using the dollar and the dollar falls versus its peers. The whole milkshake theory is that if we are going to de-dollarize, again, not just a little bit, like fully de-dollarize, it's going to send the dollar much higher, not lower. But over a short period of time, the dollar can absolutely go down. But the point I would make is if the dollar's falling, that's the Fed and the central banks and the powers that be. That's the system. That's the system continuing to survive as it has survived for the last 40 or 50 years. The dollar going lower increases liquidity in the world, and it perpetuates the status quo. It doesn't change anything. So that has always been the point. And this is, it's kind of, I've tried to use many different analogies to explain this, because people say, well, Russia, they are doing okay. And they have, largely de-dollarized. And it's a little bit like a bank run. One or two people can go to the bank, and the first, or if everybody goes to the bank to get their money, the first 1 or 2, 3 people that get there, they can get their money out. But if everybody on the same day goes to get their money, they cannot all get their money. And so, yeah, while maybe Russia is doing okay in the short term because they have natural resources and their nuclear power, just because they are so far doing okay does not mean every country in the world can just easily de-dollarize. And in fact, de-dollarizing would be an ugly deleveraging, not a beautiful deleveraging. The other thing that that I want to make clear, and when I first started talking about this at the very first interview, when I said dollars and gold will rise together, I knew that would be kind of, not controversial, but it certainly wasn't, the main way to think about things. And I knew I would have to explain it. And so I kind of went to great lengths in that interview to explain dollars and gold rising together versus foreign currencies. And I knew I would have to spend a lot of time throughout, whenever this was going on, that I would have to clarify that. What I did not think I would have to spend so much time doing is explaining what together means. Together means that they go up not at the same time, at the same rate, or it means they go up at the same time, but not necessarily at the same rate. We went over that on last week's episode. If anybody has any questions, you could go back and look at that. But if you have 10 people in a race and 2 are way ahead of the other 8, you could say those 2 are beating the other 8. That's kind of what I meant. Now, I don't know. Again, if you go back to last week's episode, I never expected the dollar to outperform gold all the time going forward until the very last crescendo. And I explained why there. But I didn't think I would have to spend so much time, meaning that, I thought there would be periods of time where gold went up a little bit more than the dollar. There'd be periods of time where the dollar went up a little bit more than gold. But in general, those two would rise against all the other currencies. And, that has largely happened over the first 2 or 3 years. The dollar outperformed gold on a percentage of how they're going to their target price. Again, we explained that last week. And then over the last couple of years, the gold has outperformed the dollars. But I've always said that you should own gold. And so many people have told me, well, why don't you just only own gold? Why do you even talk about the dollar? If the gold is going to rise versus the dollar, why do you even talk about the dollar at all? And the reason is it's very important to own gold. Gold can help in many, many ways, but gold is not going to solve all problems. It's not going to solve every country's problem. It's not going to solve every company's problem, and it's not going to solve every person's every problem. And this is an example here. I cannot tell you how many times over the last year, Zimbabwe has historically struggled with their currency, and over the last year, they instituted a policy where they were going to use some of their gold reserves to bolster their own currency. And the number of emails, Twitter DMs, and messages that people, will post things on Twitter and tag me in it saying, this is Zimbabwe using gold to get out from underneath the dollar. Well, this week, Zimbabwe again had to devalue their currency 44% against the dollar, despite trying to use gold to strengthen their currency. The bottom line is that the dollar is just still the dominant fiat currency. And just because you have gold doesn't mean it solves all your problems. Now, does it help? It absolutely helps. And can it potentially help save you in a crisis? It absolutely can. That's why you should absolutely own it. But it does not solve all the problems. The other thing is, I've always said everybody should own gold, is because it's not just the dollar that is going to lose purchasing power over time. And the other reason I said that the dollar would probably rise over time versus its peers is because it's not just the U.S. dealing with these problems. Again, how many times have we heard over the last, 5 or 10 years that China and Russia were going to band together with the other BRICS? They're going to launch some kind of a digital gold-backed currency that would leave the dollar wanting, and it would lead to de-dollarization, and everybody would flock to that currency, and because the U.S. is just printing. Well, China just launched their whatever it takes moment. They have been struggling with incredible deflationary pressures because of all the bad loans in their real estate market and their economy. And when people talk about the U.S. cut rates, well, China just did a heck of a lot more than cutting rates. And again, on a relative basis, who has the most advantages and who doesn't? I just think the dollar has many more advantages than the Chinese do. And I think the U.S. economy is much stronger than the Chinese economy. But I think a lot of the people that I interact with, they just emotionally cannot handle the idea of the dollar doing better than other fiat currencies. And I think in many ways, my experience with people in the gold world, a lot of people in the gold world, and listen, I have a lot of friends in the gold world, and I respect the hell out of them. I know that they're trying to help people, but it's my experience that many people in the gold world have a huge portion of their portfolio in gold or gold miners or silver, whatever it is. In other words, almost exclusively concentrated in that one industry rather than a diversified portfolio. And when you have that much concentration in a portfolio, I think two things happen. One is you get overly emotional about that one asset. And then you also have a really hard time thinking clearly about other assets. And so my point with gold is you should absolutely own it. I think it may, in fact, be the tiebreaker whether or not you ultimately survive any chaos to come. But I don't think it's holy. I don't think it is the only thing you should own. And I think if you do own it, you have to work to remain non-emotional about it. And I think it's especially important to do that when everybody else is getting very emotional about it. And because a lot of the arguments for gold are anti-fiat, I think many of the people, I call them the haters, but who you can label them however you want, I think that they cannot believe that somebody would think something is going to do well without also liking it, right? And so because I have said I think the dollar is going to go higher, I think they automatically think I love the dollar, that I want this to happen, that I approve of the dynamics which will send it higher, and that I am somehow a secret agent who is working on behalf of the government and putting out propaganda that is going to extend the, the US empire for another 10, 20, 30, 40, 50 years. And listen, all I can say, I mean, it's definitely entertaining, but it's so ridiculous. This is what I have to deal with. And so, you know, I was dealing with many of these these people on Twitter this week who think I'm like a CIA agent or an agent of the State Department or the Fed, or, you know, somebody whose sole job is to promote the dollar. And listen, I want to be clear. When I go back, when I came to the whole milkshake theory idea, part of the reason I knew I was onto something was because I hated the answer. And I am still extremely conflicted about the answer, truth be told. I don't like large parts of it. But no matter how I try to dig through and figure out how I could possibly be wrong, I haven't been able to convince myself I'm wrong. But I've looked. And if I could snap my fingers and make it different, I probably would do so. But it's not my job to snap my fingers and make it different. My job is to analyze the world as it is and come up with an answer of what I think is going to happen. And this is this is somewhat related, is that you don't have to like something in order to think that it could win. Like, if Darth Vader is going up against the Jawas, you don't have to like Darth Vader to know that he is going to slaughter the Jawas. He's just going to. Now, if you were going to bet on this fight with this guy on the right versus the guy on the left, who are you going to bet on? And let's say the guy on the right is the worst person you have ever. I mean, he makes Hitler look like, you know, a sweet little child, right? And let's say the guy on the left is the golden child and just does everything perfect and the nicest person ever. Do you think the guy on the left is going to beat the guy on the right? Would you bet your portfolio, your heart, and all the money that you have saved, all the hours that you have toiled away at your job, and you had to put it all on the line? Are you going to bet on the guy on the left, or are you going to bet on the guy on the right? Again, perhaps the guy on the left is some mixed martial arts Jedi, and he has some super clever technique, and he's going to jump up and poke the guy in the neck, and the big guy's going to fall. Is it possible? Sure, it's possible. But are you going to invest all of your hard-earned money on that small possibility? Again, you have to remove your emotions of what you want to see happen versus what you think is actually going to happen. And you've heard me talk about this a lot, and I'm probably going to say it in every episode if I remember to say it, because I think this is probably the most important factor that I think goes into portfolio management. You have to kind of be a mercenary about what you're investing your money in. And so again, I don't necessarily love the dollar. I don't think the U.S. is necessarily the bright, shining city on the hill. I think the U.S. has made incredible mistakes and continues to make them. But they are a big, big power, and you cannot ignore it just because you do not like it. Okay, so let's get back to the haters here. And this is the point. I can tell people to own gold. I can help people buy gold. I can say it's going to $5,000. I can say it should be the cornerstone of every portfolio. But if I don't also say that the dollar is the worst thing in history, and anybody who talks about the dollar is a horrible person, and anybody in any way associated with the dollar is basically, you know, Satan's love child, then apparently that's not good enough. And listen, all I can say is if you are of that mindset, take me out of it. Just for your own emotional well-being and your portfolio well-being, you got to get out of that mindset. You just never know what's going to happen, and you know, you don't have to be all in on one thing. And so, you know, as someone who manages other people's portfolios, diversified portfolios, if I've got a 10% allocation to gold or a 15% allocation to gold, and some people we have a 20% allocation to gold, that's probably enough. I probably don't need to sell absolutely everything else and put it all in gold. And so here's the thing, once you have your gold position, there's not much else to do. It just sits there. There's no earnings you have to worry about. You don't have to worry about the management team. You don't have to worry about, what something is said in the press about, the new strategy for the company. It's just you buy it and you have it and it's there. And it will be there when the time comes. But it's not something, part of the reason I don't talk about it as much is there's not as much to say once you have it. Then the other thing that they'll say is, you never wanted people to own gold. You only wanted them to own dollars. And then at the very end, when the dollars would spike, then you would go buy gold really cheaply. That has never been the case. And by the way, I'm highlighting a number of the Twitter interactions that I had this week. And so one of the things that they highlighted is they found a clip from 2019, or I said in January of 2019, I said where I thought gold could go down over the short term, but I thought we were getting really close to a time when gold and dollars would rally together. And so they highlighted that as me saying the gold was going to crash and that nobody should own gold. But the reality is a few hours before that clip at that same conference, I gave a presentation. And in that presentation, 3 direct quotes from the presentation were, this is why I've been pounding the table that everybody should own gold. I showed a chart and I said, I really believe this is a great reason to own gold. And I also made it clear, I said, I'm not telling you to go out and sell your gold just because I think it could go down in the short term. Everybody should own gold. So again, you can always have, you can always find something to prove your point if you want. But I think when you look at the whole story and you look at the whole package, the idea that the dollar is going to rise and you can still own gold is a really strong one. And then the other thing is because I had sent this post out about buying some puts on gold, someone said, all you ever do is talk bad about gold. You never, you're never bullish. You never think it could go up or something to that effect. Well, I went back and I found a tweet from 2022, I'm sorry, in September of 2020, where we actually bought some gold. We added to some positions. And, when I look at a chart, that wasn't a horrible time to do so. But oftentimes, people say, are you buying gold here? And I'll say, no, part of the reason is I already own it. I bought it a long time ago, so I don't have to go buy it now at the all-time highs. Hopefully you bought it at lower prices as well. But I'll say it again, even though I think gold is going to go down in the short term, and again, I don't necessarily think it's going to crash. I just think it's due for a pullback. I still think if you don't own any gold, you should absolutely go get some. But if you have gold already and you've made good profits on it and you like to do some short-term trading, I think this is an opportunity to make a little bit of money on the downside of gold. Anyway, I still think that there's going to be some pain, short-term pain in the gold world. To be clear, I don't think you should run out and sell all your gold. If you have a strategic gold allocation, hold on to it. It's done a great job for you, and it will be there when the time comes and you need it. And I'll go back to that commitment of traders report. I don't know for sure which side's going to win. I think probably the speculators will get hurt again, but maybe they won't. But one way or the other, if you don't have any gold, go get some gold for your strategic allocation. If you do have gold, don't go and sell it. But if you do like to do some short-term tactical trades, if you like to hedge some of the profits in gold that you've made, I think now is a good time to do so. Anyway, that's it for now. That was a long kind of a soapbox, kind of a self-indulgent rant. So I apologize if it was somewhat repetitive to what you've heard before. But I think it's important, especially now, when emotions are running high, things are getting more maddening than ever. I think it's important to understand what people's arguments are, what it is they're using to make these decisions. And as it relates to that COT report, I really just want people to understand, what it means and how it works. And you're welcome to draw your own conclusions from it. But hopefully this has been somewhat helpful and enlightening into how all that stuff works. And I wish you guys all a great week, and we'll talk to you again next week. See ya.